Hello guys, once again welcome to our YouTube channel eduhub, and as you know, this part 4 of stock market investment for beginners, so please don't forget to like our video, and without wasting time let's get started. Stock market investment for beginners part 4.
So welcome back. Now we enter into the third section of the course, where we shall talk something about the rules and parameters of the game. Alright. So now, having understood the play field quite well, and we are also familiar with the players in the team. We have discussed about them, the various players, investors, traders, arbitrators, hedgers and others. So now let us prepare to enter the game. Alright, we'll take our first step and try to enter the game. But the issue is, what role would you like to play? You see, there are various players in the game. Which one would you like to become? Now, since you have enrolled for this course, these choices are not available with you. Alright, since you have enrolled for this course, you either want to become an investor, or you want to become a trader, or maybe both of them. You want to perform both the roles. See, the issue is, though the rules of the game remain the same, the techniques or the skills required for an investor and a trader are different. If you want to be an investor, then you need to know what is fundamental analysis. You should be able to do fundamental analysis. We'll talk about it, what it is. And then you should know how to read the financial statements. What are the financial statements of a company? The balance sheet, the cash flow statement, the profit and loss statement. These things reveal a lot of information about the company, financial information, and you should know how to read and understand these financial statements. Then you also need to know how to do some ratio analysis, the investment ratios, profitability ratios, liquidity ratios. All these are the terms which you would need to get familiar with, and you need to understand those things if you want to become an investor. And then the stock parameters like the book value, the price earning ratio, the earning per share, and many more things like that. And once you know all these things, then as an investor, you have to be relaxed and patient. You don't have to be on your toes all the time if you are an investor. But if you are a trader, then all these things are irrelevant for you. You need not know any of these things if you just want to be a trader. And if you want to be a trader, then you should know these things. You should know technical analysis that is based on the demand and supply of a particular thing. Here in our context, it is the shares, all right? So technical analysis is something which is absolutely different from fundamental analysis. In fact, they are 180 degrees apart, all right? Then you should know something like candlestick patterns, candlestick charts and things like that. If you have ever seen, some charts like these candlestick charts, you should know how to read and understand these charts and patterns if you are interested in being a trader. All right, this concerns with the technical analysis and the candlestick patterns. Then you should also know things like derivatives, futures and options. If you are a trader, then you will often need to indulge in futures and options. As an investor also, at times for the purpose of hedging, you indulge in futures and options, but as a trader you do that more often. And then after knowing all these things is not enough. If you are a trader, then unlike an investor, you have to be on your toes all the time. You cannot be relaxed because the price keeps changing so fast that you have to keep your vision. You need to buy when it is low, you need to exit when it is high. So therefore you have to be constantly on your toes. Now, as we proceed in the subsequent lessons of this section, we shall learn something about investing and also something about trading. All right? All right. So now you have decided that you want to be an investor. So therefore, as an investor, you would be buying a stake in the company. You will be buying a portion, a very, very, very small portion of that company. All right. And therefore, when you put in your money in the company, you would wait for a reasonable time, and then you would see your money grow. You would want your money to grow. And then when your money has grown sufficiently well, adequate enough, then you may want to withdraw. If you feel that it has grown enough, then you may want to withdraw your money by selling off your shares. Not necessary. As an investor, you can continue to remain invested for long, but at times when you need your money, you may have to, or you may like to withdraw your money. All right. So before buying a stake in a company, since you are going to keep your money for a long time, you would see whether that company is fundamentally good or not. Even when you go to the market to buy tomatoes for your use, for your personal use, you would like to check whether those tomatoes are good enough or not. You will not buy rotten tomatoes for yourself. All right. So in this case, when you are buying a stake in the company or buying the shares, you will do some fundamental analysis. All right. So now let us see what fundamental analysis is. Don't worry. I do not intend to make you an expert in fundamental analysis. All what I'm going to do is broadly explain to you as to what is fundamental analysis and how can you go about it. See, fundamental analysis is a subject in itself altogether, and it may take me several hours to explain that. But I would not like to mix that with this course. This course is about a comprehensive knowledge of the stock market. So if I start explaining fundamental analysis, then I will be digressing from the topic and making it complicated for you. So let us keep those things separate. Here I will broadly explain to you the fundamental analysis so that you are adequately equipped to understand what it is. All right. So when we talk about the fundamental analysis, there are three things or three steps involved in it. And you have to go about these steps in sequence. The first is you do an industry analysis. All right. Then you will do the company analysis. Within an industry, there may be several companies. For example, you talk about automobile industry. Within automobile industries, there may be 10 different companies of automobile in your country. All right. And then once you have done the company analysis, you have to do the stock analysis. Let us briefly see what these things are so that we get a comprehensive knowledge of the subject. All right. So the first thing when you are doing the industry analysis, you have to decide which industry you would want to invest in. There may be various industries in your country: automobiles, telecom, metals, mining, shipping, and IT. So many consumer durables, consumer goods, so many industries will be there in your country. Which industry would you want to invest in? Where are the growth prospects higher? You have to study and identify the industry. Would you like to invest your money in a printing industry or a digital industry? Now gradually the paperwork has already moved out. Printing industry probably does not have so much of demand in the modern times. Gradually we are shifting to a digital world. So just an example I am giving here. Which industry would you want to put in your money? That analysis you have to do by studying the various industries as to where the growth prospects are more, and then you invest your money in that particular industry. All right. You have to see whether the technology is fast changing. You invest in some industry where the technology is changing very fast. So if the technology changes, then your money goes waste. A new technology comes in. For example, you see the photography industry. In earlier days, we used to have those paper photographs. All right, the cameras, the Kodak cameras and all those things. but suddenly that thing is vanished now. We have moved to the digital world. So would you want to invest in such an industry where the technology would change very fast and make that industry redundant? I'm sure not. So you will select an industry where the technology is new and likely to remain for years together now. All right. And then you will see whether that industry is labor intensive or technology intensive. Whether you want your money to be dependent on people, that is labor, or you want it to be dependent on technology. There are pros and cons to this. You will evaluate those things, and then you will identify one of the industry, or maybe you will prioritize. And if you want to invest in say 3 different industries, you will prioritize and determine as to which 3 industries you would want to invest in. So let us say you have identified that you want to invest in an automobile industry. All right, for an example, hypothetically, let us say you want to invest in an automobile industry. So now you will do the company analysis. Within the industry, which company you would like to invest in. In a given industry, there may be 10 different companies in your country. There may be 10 different companies making automobiles. All right. So within the industry of automobile, there may be 10, 12 different companies. Which one is doing better than the other? Who is the market leader? What is the size of the company? Where does the company rank? Does it rank first from the top or first from the bottom? All right. What market share does it have? Does it capture only 5% of the market, or does it capture 55% of the market, or does it capture 75% of the market? How big is the market share of that company? How is the management of that company? Is the management reputed, or are there crooks who are managing that company? You would like to see that. You would trust a management which is honest and good. What is the growth record of that company? How has that company grown over the past few years or past few decades, or has it gone down in growth? Then you will do some financial analysis, some analysis of the financial statements, whether the company is financially sound. Does it have adequate cash on its balance sheet? What does the financial statements reveal about the company? Does the financial statement reveal a gloomy picture? The company may be doing very well at present, but by looking at the financial statement, you will come to know whether that excellent performance is likely to continue in future, or there are gloomy days ahead. Those things will be revealed by the financial statements. How much the risk the company carries, that will be revealed by the financial statement. Got the point? The financial statements will reveal how much risk the company has, depending upon what is the debt equity ratio of that company. All right. So after having analyzed one of the best companies where you want to invest, then you will do the stock analysis. You see, if the automobile industry is doing good, generally all the companies, if the industry is doing good, then generally all the companies in that industry will be performing reasonably good. The industry may be great, the company within that industry may be superb, but the point is whether the stock of that company or the share of that company is worth the price. Say for example, you go to buy apples in the market, all right, and you select the best available apple in the market costing $20 a dozen. Okay, and the next best available, which is slightly inferior than the one which you have selected, that is costing only $10 per dozen. All right, the best one is $20 per dozen, and the second best, which is marginally less than the best one, is costing only $10 per dozen. Now, which one would you buy? Would you go for the best at double the cost? Certainly not. So that is what you will do while purchasing the shares also. You will look for the best, but not at any hypothetical price. you will see whether the price is justified. All right. So is the price what you are paying worth it? To determine that, you will have to see whether the stock is already overpriced. The whole world knows that the industry is good, the company is good, and therefore everybody would want to buy that shares. So in that process, has the share price already become overpriced? If yes, then you may have to wait for a correction for the price to come down to some extent. You may have to check the book value, the reserves and surplus of the company, how much reserves and surplus the company has, what is the price earning ratio, what is the EPS, the dividend history, dividend yield. So many things you will study, compare for various companies. All right, you have selected an industry. Within the industry, you have say selected, there are 10 companies in that industry. Out of those 10, you may find that 3 are not even worth looking at, so the 7 are good enough. So for those 7 companies, you will try to analyze whether their share price are overpriced or underpriced or reasonably priced. Then out of these 7 which you find are available at a bargain price, you would want to put your money in that particular stock. So I hope you have broadly understood as to what fundamental analysis is, what is the importance of this fundamental analysis, because as an investor, you are going to put in your money for a long time. Therefore, you want to check from all angles whether where you are going to put your money is a reasonably good place or not. So got the point? So welcome back. I hope you are enjoying the course, or at least it is not very boring. If you have been watching it continuously, then I would suggest that you have a break and see this lesson with a fresh mind. So now that you know what is fundamental analysis, let us try and understand what are financial statements and what do they reveal or what do they convey. But the point is, whose financial statements or whose financial status will you see? You have to remember that the company and the owners of the company, that is the promoters and the shareholders, and the management of the company, that is the board of directors, these 3 are separate entities. Each of them is a separate entity altogether. Owners can participate in the management. If the owners, the promoters have a high shareholding, they can become board of directors, they can become members of the board, but still the ownership and the management will remain separate. So whose financial statements are we interested in? We are interested in the financial statements of the company. We are not interested in knowing whether the promoters are rich or poor. What is their status? That we don't want to know. We want to know about the company. At times, you may have seen in the news also, and otherwise also you may have come to know that certain companies are becoming bankrupt. The companies don't have adequate money even to pay salary to the staff. But at the same time, the promoters are traveling in private jets, they are living in big mansions, palaces, and they have lot of money to spurge. But the company is moving towards bankruptcy. Why is that? That is because the 2 of them are separate entities altogether. If the company has not performed well, if the company has failed or has become bankrupt, that does not mean that the promoters will pool in or put in their personal money to revive the company. They too are separate entities. So now let me explain to you what are financial statements. See, when you go to a doctor, how would a doctor check your physical health? You want to know how your physical health is. So how will the doctor see that, or how will he check that? He will look at the medical documents, some blood report, some ECG, some x-rays and things like that. He will study them and then he will determine about your health. Similarly, as an investor, If you want to invest in a company and want to know how is the financial health of that company, then you will have to look at their financial statements. What are these financial statements? The first one is a balance sheet. The second is a profit and loss statement. And the third one is a cash flow statement. These are the three main financial documents which you have to study to know the financial health of the company. Now comes the question as to how to read and understand these financial statements. Now, reading and understanding financial statements is a subject in itself. It is a separate topic altogether, and for that we have a 5-hour course containing 42 lessons on Udemy. It is titled Understanding Financial Statements, Stock Selection Process. Now at the moment this is the highest rated course, but when you are watching this lesson, I do not know whether it will remain highest rated or not. I can only hope for the best. Now I am not trying to market or sell my course. Please do not view like that. The point is, if I try to explain the financial statements here, a 5-hour course in this course itself, then I will be digressing from the topic. It will complicate the issue and it will make a cocktail or a mocktail of the current course also. It will spoil the taste. But notwithstanding that, in this lesson, I shall explain to you as to where would you find these statements, how do these statements look, and what do these statements contain. Where can you find these statements? See, these are mandatory documents and they are required to be submitted by the company to the regulatory authorities, and therefore these are on the public domain. The company have to give them to the public shareholders also. All right, so you can find them on the company's website, or you can find them on the regulator's website. You can also find them on the stock exchange websites, or the website of any good broker or the depository participant or the clearing house or whatever you may call them. I personally look for these statements on a website called www.moneycontrol.com. This is in India. In your own country, you may have different, these trading platforms. So anywhere you can find these financial statements. They are nothing secret. They are available in the public domain. All right. So now coming to the balance sheet, the first statement. This is how a balance sheet would look like. I have taken the screenshot from the moneycontrol.com. See, on one hand you have the equities and liabilities. Together I call them as liabilities. And on the other hand you have got the assets. So at any given point of time, the assets and liabilities have to be equal. When you understand these things in more detail, you will realize how they are balanced. All right, normally these liabilities are on top and assets are given below that. They are not generally side by side. Just for the sake of convenience, I have shown them. I have taken a screenshot and shown them side by side. So there are various things you will see in the balance sheet, and not only for 1 year, you will see the data for the past 5 years at least, to see how the company has been performing. For example, just as a sake of example, I am giving here reserves and surplus. We have seen earlier during the course what is reserves and surplus. The reserves and surplus here are constantly increasing. This is a company called Tata Steel. Now the reserves and surplus are constantly increasing. That means every year the company is earning good net profit. Some profit they are distributing as dividend, the remaining they are reinvesting, and therefore the reserves and surplus are interesting. So this is giving you a positive sign. Similarly, other data will also convey certain things. Next is the profit and loss statement. This is how a profit and loss statement will look like. On the top, you will see the sales. See, the sales have constantly grown over the years. This is called as the top line, and the net profit is given at the bottom. This is called as the bottom line. You would have heard normally in the business news channels, top line and bottom line. Now for a good company, both top line and bottom line must grow. The sales must grow every year, and if the sales grow, then the net profit must also grow. It shouldn't happen that only the sales are growing, but the profit is not growing. The company is selling goods in large quantity, but selling them at a loss, and therefore the net profit is not increasing. So when you look at the profit and loss statement, you must see that the top line and the bottom line both are growing. Even if the top line is not growing much, the bottom line has to grow. Even if the sales are less, at least the profit should be more. Got the point? And then you have the cash flow statement. This talks about where the cash is coming from and where the cash is going. Operating activities are those things which are the main bread and butter of the company. For example, an automobile company. The money which comes in by selling automobiles is called as the operating activity. Alright. The same automobile company may also have other investments, may have some fixed deposits, may have some godown or a big shed given on rent. The income coming from that is not called as income from operating activities. That is other income. Alright. And similarly, the investing activities. The company may invest their surplus money into some other company or into some other assets. So if the money is going out, then it is a negative sign. They have invested elsewhere. Or if some investment has matured and if the money is coming in, then it will be a positive sign. Similarly, then you see the financing activities. These are basically whether the company has borrowed money or the company is returning the borrowed money. Here you see a positive sign. That means the company has borrowed this money, which is not a good sign. Here the sign is negative. That means this much of money has gone out in financing activity. Most probably the company has returned some loan, returned some debt. So it's a good sign. So when you analyze these things for the past 5 years, you will get a lot of information about the company, whether the company is doing good or not doing good. So now let me explain to you the balance sheet. The balance sheet actually tells us how much money does the company have at any given particular time during the year. The balance sheet is normally prepared on the last day of the financial quarter and the last day of the financial year. That is the time the shareholders and the public would want to see how much money the company has. So therefore, it tells you what is the company's worth in its books, not the market value, but in the books, what is the worth of the company. But the balance sheet does not tell you how much money has come in or how much money has gone out. And it also does not tell you where the money has gone out or from where the money has come in. Those things are not revealed by the balance sheet. All right. Then the next one is the profit and loss statement. The profit and loss statement actually tells you how much money has come in the form of revenue and how much money has gone out from the company in the form of expenses. This was not told to you by the balance sheet, but the profit and loss statement tells you that. All right. If the money coming in is more, then of course the company is in profit. And if the money going out is more, then it is in a loss. So therefore, the profit and loss statement tells you whether the company is in profit or loss. But again, it does not tell where the money has come in from or where the money has gone. This will be told to you by the cash flow statement. So the cash flow statement is actually telling us where the money has come in from and where the money has gone. That means, is the money being judiciously or wisely utilized by the company? The money may keep coming and going out, but is it coming in and going out in the right form? Is the money being wisely and judiciously utilized? that is revealed by the cash flow statement. Alright. So I hope you have broadly understood as to what are financial statements, where do you find them, what do they look like, and what do they contain or what do they reveal. If you find it interesting and if you want to study the subject in depth, then you may enroll for one of the courses on financial statements, not necessarily my course, any other good course on Udemy or anywhere else. You may also study the subject by reading books. Alright? So welcome back. Now we have a reasonable idea about what financial statements are and how do we look at them. Now let us see some other stock parameters and some other ratios which also form part of the fundamental analysis. Now, just for the sake of understanding or for a clear relevance or significance of what I am trying to say, just think over that you go to a vegetable market to buy tomatoes, alright? And the shopkeeper tells you that the tomatoes are available for $3 per kg. Now, would you just pay the price and blindly buy the tomatoes? I'm sure not. You would like to see the size of the tomatoes, the color, the texture, the stiffness, the freshness of the vegetable, and maybe you would like to taste one of them. At least I often do when I go to the market. And then you will decide whether the price what you are going to pay is commensurate with the product or the product is commensurate with the price. And how will you do that? By comparing these parameters with the tomatoes available in the other few shops, isn't it? Similarly, when you want to buy shares of a company, you won't pay the price blindly. You would check certain parameters and then compare those parameters with other similar stocks and only then decide whether what you are paying is a reasonable price or not. So what are these parameters and the ratios that we are talking about? Some of them are the basics. These are the face value, the book value, and the market value that we have already discussed in the earlier lessons. These figures or these parameters in themselves does not convey anything, but they help us in understanding the other things. Let us see what are those. There are certain feel-good parameters. Again, these parameters in themselves convey nothing, but they just give you a feeling, a good feeling or not so good feeling. If you get a good feeling by seeing these parameters, then you would want to go into more depth and study further. But if these parameters don't give you a good feeling, then you may like to give up. You may not like to waste your time in further analysis. And what are these parameters? The first one is the sales. You will see whether the sales of that company, the shares which you are going to buy, whether the sales of that company are on an increase or a decrease over the past few years. Then you will see the net profit and the reserves and surplus. This I have already discussed. While seeing the financial statements, you will definitely have a look whether the net profit of the company are on an increase or on a decrease. And how about the reserves and surplus? Is it that only the net profit is increasing and everything the company is giving back to the shareholders, the reserves and surplus are not increasing, or how is that? Then you see the earning per share. Earning per share is nothing but the net profit divided by the number of equity shares. So how much each equity share is earning, that you would like to see, whether that is on an increase or it is stagnant or on a decrease. If it is not increasing, why is it not increasing? Then you see the return on equity. Return on equity again is nothing but the net profit divided by the shareholders' equity. Here you have seen the number of equity shares. Here you are seeing the equity amount, the amount invested by the promoters, and the shareholders, all right, including the reserves and surplus, because that is the shareholders' equity, all right. So whether the return on equity is on an increase or not, and how much is that? Is it more than some threshold value, say 20%, or is it less than the threshold value? You will see that. Then you will see the return on capital employed. Return on capital employed is the EBIT, or the earnings before interest and tax. See here, in return on equity, you have seen the net profit. That net profit is after paying the interest and tax and everything. All right. But EBIT, now when you want to, decide the return on capital employed, then you are seeing the earnings before paying the interest and tax. So this will be more than the net profit. And similarly, here you are seeing the capital employed. In this case, you have seen only the equity. Here you are seeing the equity plus the long-term debt. All right, so these figures will be different. You will compare this with similar other companies. And then you will see the dividend history. Whether the company has been paying dividend. If yes, then how much? And is that dividend payment on an increase over the past few years, or is it declining? So these are the things that you will be seeing. Then there are certain investment valuation ratios. You will see these ratios will give you an idea that what value you are paying for your investment in that particular company. So number one is the dividend payout ratio. This is the amount of dividend per share in terms of percentage, and then the divided by the earning per share. All right. How much is the earning per share? This entire earning per share, as we have discussed earlier, rightfully belongs to the shareholders, isn't it? But the company is not going to give you this entire amount in the form of dividend. A good company will give you a small amount as dividend. The remaining portion they will reinvest for growth. So you have to see how much is that ratio. How much of that earning per share the company is giving you out as dividend. All right. Then there is something called as dividend yield. There is a difference between dividend payout ratio and dividend yield. Dividend, as you know, is given on the face value of the share. So if the face value of the share, let us say it is $10, and the company says that the dividend is 50%. That means 50% of the face value. All right. So 50% of the face value is how much? $5. So if the face value of the share is $10 and the dividend declared is 50%, you get $5 per share as dividend. All right. But then what is the yield? That depends on the market price. The face value may be $10. But what if the market price of that share is say $100? In that case, you are just getting $5 per $100 of the market price. So that dividend yield becomes 5%. The dividend payout ratio, dividend per share is 50%, but actually what you are getting based on the market price is just 5%. You got the point what I'm trying to say? So these things you will see and compare with other companies. Then you have something called as the price to earning ratio, or the PE ratio. You see, PE ratio is the market price of the share divided by the earning per share. Now as a layman, if you see, if the market price of the share is more and the earning which the share gives is less, then this ratio is going to be a bigger figure. And if you see, if the market price is less and the earning given by the share is more, then this figure will be a smaller figure. So normally as a layman, you may feel that a lower PE is good. The stock is undervalued if the PE is low. That is true, but not fully correct. You have to look into details and answer the question as to why the market is willing to pay a higher price for a share whose earning is less. There must be some reason. All right. So therefore, when you look at the PE, try to understand that PE, compare it with the PE of other industries or the other companies in the same industry. Have a detailed look at that. I'm not going to go into the details now, but I would just like to advise you that when you are looking at the PE ratio, look at it very carefully. Then there are certain things called as the profitability ratio. These profitability ratio tells you how profitable the company is as on date and how profitable it is going to remain or likely to remain in the future. Among that you have the gross profit margin. That is the gross profit divided by the sales. And then you have something called as the operating profit margin. This is the operating profit divided by the sales. Now what is the difference between these two? You see, consider a company, for example, an automobile company making automobiles. All right. So that automobile company is earning profit. One is by selling automobiles. And in addition to that, that company may have invested some money in some other ventures, in some other companies. Or maybe that company has got a large piece of land which it must have rented to somebody and must be earning a rental income and then earning, that is the profit. So the amount or the profit which the company earns from various sources together, that is called as the gross profit. But what it is earning from its prime business, and that business is selling automobiles. So whatever profit the company earns only by making and selling automobiles, that is called as the operating profit of that company. All right. So we want to invest in a company which earns more profit from their core business, their main business, because we are investing in a particular business. All right. We don't want the company to earn from various sources. We would like to look at a company whose major profit is from its main operation. Got the point? Then there is something called as a net profit margin. This is the net profit after paying all the taxes and dues. That amount divided by the sales. So these figures will give you a fair idea as to what is the profitability of the company. And when you compare these ratios with similar companies in the same industry, you get an idea as to where this company stands. Then you have something called as the liquidity ratios. Now these liquidity ratios tell you as to how quickly that company can convert its assets into cash or real money. Because at times the company would require cash or real money for various activities. It's, the working capital and various other requirements. The company would require ready available cash. How easily and how quickly that company can convert their assets into money is an important factor. It shouldn't happen that at the time of need, the company has to sell off its land and machinery to generate cash. It shouldn't happen like that. So therefore, this situation is conveyed to you by something called as the current ratio. Current ratio is the ratio of the current assets divided by the current liabilities. I am not going to explain again in detail. I have already explained this in one of my other courses, that is about the financial statements. But don't worry, I'm just giving you a broad idea. Then you have something called as the quick ratio. What is this quick ratio? You see, when you talk of the current assets, these current assets include the inventory of the company. Inventory is the ready product which is awaiting the sales. So to sell those products and generate money, the company will require some time. But if you want the money quickly, then you can't wait for selling off the product. So therefore, from the current assets, when you exclude the inventory and then divided by the current liabilities, you get something called as the quick ratio. Don't worry, all these ratios you don't have to calculate. You just have to understand them and their significance and their relevance. These ready figures are available on the website of the company or along with the financial statements or on various other websites of the DP or the broker or the clearing house or the stock exchange, as I have told you earlier. All these figures are readily available. You only have to look at them, understand them, analyze them. All right. Then there is something called as a debt equity ratio. This gives you an idea about how risky the company is. This also we have discussed in detail in my other course about the financial statements, and also about the basics, the course which you have about the fundamentals and concepts of finance. This ratio actually, just to give you an example, if a company has borrowed money from the lenders and how much interest it is paying to the lenders. Say for example, if the company is earning a profit of 15% and the interest which is giving on the debt or the loan is only 10%, then it is a good proposition, a good situation. Company is earning 15%, giving as interest only 10% and pocketing the remaining 5%. It's a good situation. But think otherwise. Say if the company is earning only 10% profit and it has to give interest on the loan for 15%. That means the company has to shell out 5% from its pocket. So that type of debt is not good. So it depends, the debt equity ratio, how it is, how the company is managing it. Is the company able to manage the debt properly or not? These things are to be seen from these ratios. All right. So as I have told you, these ratios by themselves convey nothing unless you compare them with the same ratios of other companies in the same industry. All right. Say for example, you have gone to buy tomatoes. You won't come to know the worth of those tomatoes unless you compare them with the parameters of these tomatoes with the parameters of the tomatoes available in the neighboring shop. Then only you will be able to decide whether the price which you are paying is a reasonable price or an overprice or underprice, whatever it is. All right. And then when you are comparing, you have to compare apples with apples and oranges with oranges. Meaning to say that when you are looking at an automobile company, you have to compare the parameters of an automobile company with a similar automobile company in the same industry. The size generally and the type of work or the manufacturing has to be the same. You cannot compare apples with oranges. You can't compare an automobile industry, the parameters of an automobile industry with the parameters of an IT industry. No, you cannot do that. All right. So when you are comparing, just keep in mind that the comparison is between equals or similar things. All right. So here I have not explained to you in detail as to how the analysis or the ratio analysis is to be done. That is not the aim or purpose of the course. I do not intend making you an expert in fundamental analysis or ratio analysis. All right. I have just given you a broad idea. And once you are familiar with this broad idea, once you get this broad picture in your mind, then it will set your mind thinking and you will start finding answers to your questions. All right. And that is the aim of this course. So please do not get away with the idea that I have conveyed to you everything about the fundamental analysis or the ratio analysis. No, this is just the beginning. This will set your mind thinking and you will look for more answers. All right. So here we conclude with the fundamental analysis. In the next lesson, we shall talk something about the technical analysis. All right. So after broadly understanding the significance of the candlesticks and the candlestick patterns, let us try and understand some technical indicators for the technical analysis. Now the first question which will come to your mind is where to find the technical indicators. You see, you can get the technical indicators from any good financial website or the website of your broker or the depository participant, or there are so many websites which will give you the technical indicators. All those websites which illustrate the stock charts, they will also give you the technical indicators. I personally follow this one, investing.com. in.investing.com is in India, but if you are in the USA, then you can go to the USA website of investing.com. If you are in Canada, then you can go to ca.investing.com. Similarly, for UK, there is the UK website. For Singapore, there is the Singapore website of investing.com. So let us go to investing.com. So being in India, you come to the site in.investing.com. If you are in the US, then accordingly you go to the US website. If you are in Canada, then you go to ca.investing.com. In the United Kingdom, you go to uk.investing.com. Accordingly, in Singapore, you go to the Singapore site. All right. Now coming back to the Indian site, since we are in India, the moment we open the site and in this, the box, the moment I put the symbol of the stock, I have put here SIEM, which is for the Siemens Limited, then we get this basic candlestick chart over here. All right. Then there are various things. You can see this chart on a 5 minutes interval. You can see it on a 15-minute interval, 1 hour interval, 1 day interval, 1 month, or any other format which you want. Then there are various other facilities. We will not go into those details. Now looking for the indicators, when you go here, see this, some indicator is made here. Can you see this? The moment you click here, you get a drop down menu and there are various indicators which are shown here. You can select any of them. Like for example, let us select on balance volume. The moment I click here, that indicator will come below this candlestick graph. All right, what you see here, this portion, this is the on balance volume indicator. What it is, how to read it, we will discuss in a moment. But at the moment, I'm just trying to explain to you how the indicator will come in front of you. Now, if you want to have one more indicator below this, then again you can go here, click on this, go to the drop down menu. Let us select one more. Which one do we select now? Let us select probably MACD, that is moving average convergence divergence. The moment I click this, this also will come below the first indicator. So now you have the candlestick chart in front of you and you have two indicators below that. You can study that now. If you want to add one more indicator, you can add one more below that, or as many as you want, you can add. But the more you add, the more confusing it will become. If you want to change anything, you want to remove this indicator, just click here and the indicator will be removed. So now you have got only one left, that is MACD. You can study MACD in relation to this candlestick chart which you see here. All right. Now the issue is that when you click this, there are about 79 indicators which are shown here. And it is practically impossible for any human being to study or track 79 indicators at a time. The problem is not only that. The problem is that one indicator might tell you that the price is likely to move up, and the other indicator may tell you that the price is likely to go down. So what do you do in such a case? So we have to remember that technical indicators are not the nature's law. They are just probabilities and theories which have been documented by great people in the past. People who have studied the stock market, they have done a lot of research, and based on their understanding of the stock market, they have documented certain facts that how the market behaves, and they have given the technical indicators to the world. Now, you see what I'm trying to say is, for example, when you say an apple falling from a branch, when an apple breaks from a branch, the apple will fall down to the ground. That is the law of nature. Newton has noticed that and he passed it to the world. Now there are no two ways about it. An apple falling from the branch or breaking out from the branch has to come to the ground. It can never go up into the sky. Alright? But that is not the case with technical indicators. These technical indicators are just theories and possibilities documented by learned people. They are not the law of nature. You see, a technical indicator may say that the price will go up, but the stock market is not bound to obey that. This indication that the price will go up is only based on the experience of the person who has formulated that indicator based on his research and study, and he has given it to the world to follow. All right. Based on his study or her study, whatever it is, the price may go up more number of times, then it may come down. When the indicator says that the price is likely to go up, it only means that the probability or the chances of the price going up are more than the price coming down. And similarly, when an indicator says that the price is likely to come down, it only means that the probability of coming down is more than the probability of going up. And therefore, as I have told you earlier, out of those 79 or 80 indicators, all of them will never say the same thing. Some indicators will say the price is likely to go up. Some will say the price is likely to go down. Some will remain neutral. So based upon your experience, your learning, your wisdom, you have to choose a few indicators and then follow them with some rationality. All right. So in the next lesson, we shall try and understand a few of the indicators. Now, having understood what a candle is, let us try and understand what is the significance of a candlestick. Suppose on the screen, if I have to convey to you that yesterday the Nasdaq opened at 14,650 and during the day it moved between 14,550 and 14,840 and then finally closed at 14,775. Quite a complicated statement, first of all to read, then to comprehend, and then to frame in the mind. It becomes little complex. But the same thing, if I represent or show to you in the form of a graph and a candle, then it becomes very clear. First of all, the candle being green, you would clearly understand that it is a bullish movement. The opening price is lower than the closing price. All right. So opened at 14,650. That means this point is the opening price, 14,650 here. And then during the day, it moved between 14,550 here and 14,840, this upper limit. And then finally closed at 14,775 here. All right. So the green candle means it is a bullish movement. It opened lower, closed higher, and these two tips representing the range during which it moved. Similarly, if I were to tell you that Nasdaq opened at 14,775 and during the day it moved between 14,550 and 14,840 and then finally closed at 14,650. So now you would understand that if it is a red candle, that means the price opened higher and closed lower. So it opened at 14,775. All right. During the day, it moved between these two ranges, the maximum and the minimum. This is the range in which it moved during the day and finally closed at 14,650. All right. So the color indicates to you whether it is a bullish move or a bearish move. And then the tip of the wicks and the edges of this candle convey the whole information to you when it is on the graph. Now it were if only for one day, if I had to give you a picture of only yesterday, then I would not require the candles. I may probably explain to you in the form of a sentence only. But imagine if I have to give you a picture of the entire past 1 month, or maybe 3 months, or maybe the one full year. Then how do I do it? I won't be able to explain to you in the form of sentences because it will clutter the whole screen. But the same thing, if I have to represent in the form of a candlestick graph, then it becomes something like this. You see here it is a 5-minute interval candle. So each candle is depicting how the tug of war between the bulls and the bears have panned out over an interval of 5 minutes during the day. Alright, and here if you see, it shows how the battle has panned out over intervals of 15 minutes. Each candle is showing you a battle of 15 minutes. Then here if you see, it shows about 1 hour. Each candle is representing a period of 1 hour. How the battle between the bulls and the bears have panned out over intervals of 1 hour. A combination of green and red candles, sometimes up, sometimes down. The same way as you see in the tug of war between two teams. And here if you see, this would represent 1 day. Each candle is representing a period of 1 day, or the battle for the 1 day. So therefore, between April and May, if you see, the number of working days, depending upon how many working days are there, 12, I correct myself, maybe 22 or 23 working days in a month. Here if you see, it is on a monthly basis. Each candle representing 1 month battle. Alright. So if you see from 2019 to 2021, a 2-year period would have 24 candles. On the other hand, we have seen if it were a 15-minute interval, then 1 hour would have 4 candles. Here 2 years are having 24 candles. So depending upon how you want to look at the battle which has happened in the past, whether you want to see it at an interval of 15 minutes, or you want to see it on a daily basis, or you want to see it on a monthly basis, you can have look at the appropriate chart and then make your assessment. Alright? Alright, so we have studied fundamental analysis and now we are going to study technical analysis. Alright? Let us try and understand what is the difference between them. Fundamental analysis, basically it is for the investor, and technical analysis is for the trader. Alright? So now we have seen that the fundamental analyst basically says that I will analyze the industry, I will analyze the company, I will analyze the ratios, and then I will tell you whether the share at which you are looking is underpriced, fairly priced, or overpriced. And I will also tell you as to where the share price is likely to be after a year or maybe after a couple of years. That is precisely what a fundamental analyst does. Alright? But the technical analyst has got an entirely different view. He says that look, the market is intelligent enough and the market knows how to balance the price. All your analysis, whatever you are saying, blah blah, the technical analyst is telling the fundamental analyst. Alright? He is saying that whatever analysis you are doing or you have done, that is already factored into the current market price of the shares. I don't want to listen more about that. Alright? He says that I don't have time to wait for a year. The technical analyst is saying that my livelihood depends on what I earn by buying and selling in the stock market. I don't have time to wait for a year. I want to know whether the price will go up or down in the next 5 minutes, or maybe the next 30 minutes, or maybe next few hours, few days, few weeks. At the most, if you want, I can wait for 3 months, but not beyond that. If I wait for more than 3 months, then I no more remain a trader. I become an investor. And I don't want to become an investor. I am a trader. That is what the technical analyst is telling the fundamental analyst. Alright? And so he says that I don't want to look at your analysis. I have my own set of parameters to decide whether the price is going to move up or move down. And what are those parameters of the technical analyst? Those parameters are basically the demand supply situation and the price volume data. These are the two main things apart from various other things which the technical analyst looks at. Now to understand this, just imagine that a company, any company XYZ, has issued 10 million shares, out of which 2 million shares are with the promoters and the remaining 8 million shares are held by this public. Alright. So out of 10 million shares, 2 million shares are with the promoters. Promoters normally don't sell their shares, but the remaining 8 million shares which are held with the public, they are freely traded on the stock exchange. Now just imagine at any point of time, let us say the number of buyers for that particular share of that company XYZ which we talked about, the number of buyers for that share in the stock market are much more than the sellers. People who want to sell are much less than the people who want to buy. So what will happen? Because the demand is more people are wanting to buy the share, the price will go up. And how much will the price go up? For that particular moment, it will depend as to what is the difference in the strength of the buyers and sellers. Alright. Similarly, let us imagine that if the number of buyers are very few and the number of sellers are more, lot many people want to sell, but only few people want to buy. So what will happen? Everybody is trying to sell it out, so the price will go down. Alright. And how does one come to know? How does the technical analyst come to know this? He gets this by looking at the charts and patterns, the candlestick charts, the price movement, and various other technical indicators. Alright. This candlestick basically is indicating the price of the stock at the particular moment. And what you see here at the bottom, these are the volume bars. They are indicating as to how much is the volume of trade at that particular moment of time. When you learn more about these charts and patterns, you will understand all this. Alright. So some traders follow only the candlestick charts. They don't believe in other technical indicators. But some of them follow various other technical indicators, which we have not talked about yet. We will be talking about them. Alright. And some traders follow a combination of candlestick charts and also some other indicators. Now what you see here, they are basically candlestick patterns. These are some of the bullish candlestick patterns. The hammer, the inverted hammer, bullish engulfing, piercing line, morning star, three white soldiers. All these patterns are basically indicating that the price which was so far moving down is now likely to change direction and start moving upward. And similarly, these are some of the bearish reversal patterns of the candlesticks. These are indicating the hanging man, shooting star, bearish engulfing, evening star, three black crows, dark cloud cover. These are all indicating that the price which was so far moving up is now likely to turn downwards. Alright. Not as simple as it appears in these figures. You have to study, understand and analyze them. Now what are the candlesticks? What are candlestick patterns? What they convey? All these things are explained in detail in one of my other courses on Udemy, that is titled Understanding Candlestick Patterns for Trend Reversal. Now this is a 3-hour course on Udemy. Obviously this entire course content I cannot include in this lesson or this course because it will become too lengthy and I will be digressing from the topic. I do not want to confuse you. Everybody may not be interested in learning the candlestick patterns. Alright. But just in case you are interested in learning it, if you want to become a trader and if you want to learn this, then you may enroll for one such course. Not necessarily my course. You can enroll for any other course on Udemy. There are so many good courses available. If you are very keen to learn the candlestick patterns, then you may enroll for one. But here, just for your basic understanding, just to explain to you what a candlestick is, the next lesson what I have done is, I have attached an extract from this course. I have just taken an extract, one lesson from this course, and I have attached in this course just to give you an idea as to what a candlestick is. Alright.